Welcome back to Accounting 5000. This is going to be Module 5. In Module 5 we're going to be talking about Chapter 3. We're going to do the entire chapter in Module 5 because we're going to talk about 5 basic things. We're going to talk about ROI, ROE, working capital, current ratio, and the acid test ratio. So let's talk a little bit about financial analysis and the ratios and the analysis that we're going to be doing in this next module. A ratio is simply a relationship of two pieces of information to one another. So all you're doing is taking a number, like current assets, and relating it to another number, like current liabilities. So don't be scared by the fact that we're doing ratios. Just think of it as in terms of two things related to one another. Ratios are really good for financial analysis. Using ratios, we can compare firms of different sizes. So it really doesn't matter that we're comparing McDonald's to Uncle Joe's hamburger stand. We can have two different size firms and analyze them and come up with the same type of number so that we can look at the two of them and compare them. What we're going to be doing when we do this comparison is to look for trends. We're going to see over time if a company is managing its assets well, if it's analyzing its resources well, what is the company doing well? As we do this analysis, we'll also be able to highlight things that the company is not doing as well. And this is one of the reasons that management does its own internal ratio analysis, is to see where they can improve parts of their operation. So don't be concerned about this. This is not a difficult chapter. It's just an interesting chapter. In this chapter, what we're going to do is take the information you learned in Chapter 2 and relate it to how it can be useful to you as an investor, a creditor, a manager, or anybody else who's interested in financial statements. So you may want to take a little bit of time and review the information we went through in Chapter 2, where we discussed the types of accounts that are in a financial statement, such as cash, accounts receivable, notes receivable, equipment. Remember what types of accounts they are, where they go on the balance sheet, and what's included in each account, because we'll be using those terms as we go through Chapter 3. So make sure you're pretty familiar with Chapter 2 before you continue. So let's talk about the 5 things that we were just listing at the beginning of this module as being our coverage for this time. Let's start with return on investment. We call return on investment a shorthand ROI, return on investment. It's a simple measure that was developed by the DuPont people, so it's also often called the DuPont return on investment or the DuPont formula. It's a simple measure of looking at what did we get back, in other words our return, related to what we invested. Now if you think about this in terms of your bank account, you put some money in your savings account, say $100, and you're going to get a return of 5%. So at the end of a year, you would get back your $100 plus 5% of that $100, which would be $105. We're going to do the same thing with a company, except the company, instead of having money to invest in a bank, invests their money in production equipment and other resources. So the question we have is, okay, using those resources, what were they able to produce? What was their return? So in a company, the return is measured as net income. So we're going to take net income in relationship to various other pieces of information, particularly average total assets. In other words, they had assets to invest. Here's what they got back in net income. How well were they doing with that investment? So what we're going to look at here is see the ability of management to control the firm's assets to produce net income. Now one of the key things you need to remember as we talk about this in the next couple of sessions is how to compute interest. So you may need to think back to 7th grade or 8th grade when you learned the old formula I equals PRT. Interest equals the principal times the rate times the time. So if you think about the example I gave just a second ago about the $100 that you invested in the bank, your interest would be equal to the principal of $100 times the rate, which was said was 5%. And when you're entering that in a calculator, enter it in as 0.05. And we think of time in terms of years. So a T of 1 would be a 1-year return. So if you're figuring the interest on $100 for 1 year at 5%, you would say I equals 100 times 0.05 times 1, which is where we got our 5%. or $5 return. Remember that equation because we'll be using it through the next couple of modules. Now, return is not the only thing we're going to be interested in as we start doing our analysis. We'll spend a lot of time on the ROI and ROE formulas and some of the liquidity ratios, but always bear in mind that risk plays a big role in analyzing a firm's liquidity and analyzing a firm's investment opportunities. Risk and return are related. The more risk you assume, the more return you want in relation to that risk. So if you invest in a bank, which is a fairly solid investment with very little risk, you would get a lower return than if you invested in a much riskier, say a real estate development investment. So be aware that as we talk about risk, we're also going to include the relationship of risk and return. So let's talk a little bit about ROI in detail and look at how we actually compute return on investment. We're going to use net income again as our return. We're going to use our investment as average total assets. Now an average, remember, is the number of things added together divided by the number of things that you added together. In this case, we're adding two things together and we're dividing by 2. So average total assets would be the beginning of the year assets plus the end of the year assets divided by 2. So we're going to take beginning year total assets, ending year total assets, divide by 2. That's going to be our average total investment in assets. This is simply going to be a rate of return on that investment. Now when we do the DuPont model, we're going to split it up. We're going to take the net income and put it over sales, and we're going to multiply that by sales over average total assets. Now if you look at the slide there, you'll see that you've got two things multiplied by each other, and those are two ratios, net income over sales times sales over average total assets. Well, if you think back to your basic algebra, if you have a number on the top and a number on the bottom that are the same number when you're multiplying two factors together, you can eliminate it. So you can see that we would actually, to solve it down to one formula, we would simply take net income and divide it by average total assets. But what we do here, if you look at that formula, is split it up. Net income over sales is something we're going to call the margin. So think about what you do when you take net income over sales. Sales is all the revenues you've generated. Of those revenues you've generated, how much do you get to keep as net income? That's what that margin tells you. What percent of your sales is actually going to come into your pocket as net income? Now look at that second factor, sales over average total assets. We call that asset turnover, or TO or ATO, often will be the abbreviation. What we're looking at there is how well do we use our average assets to generate sales. So in breaking down the DuPont model, we have two pieces, margin and asset turnover. Those two items added together, those two items multiplied together would give you the ROI for the DuPont model. Now as we're analyzing firms, realize that the ROI on most firms will average somewhere between 8 and 12%. So it won't be a heavy return, but it will be a much better return than you can actually get on a bank these days. If you put money in a savings account, you may get much less than 8%. So the DuPont model is the ROI term that we're going to be using for this module. Now remember I said there were 5 pieces of information that we were going to be calculating. The second one is called a return on equity. The return again is going to be net income. We're going to use net income as our return factor in all of these models. And equity, remember, is the amount that's been invested by the owners. So we're going to take an average owner's equity, which again is taking beginning owner's equity, adding the ending owner's equity to it, and dividing it by 2. This will give us a measure of how well a management is doing in using the investment by the stockholders to produce net income. So this will be a return, if you're a stockholder, the return that you're getting on your stock. Typically, in a business today, you'll get anywhere between 10 and 15% return on your equity investment, which again is a pretty good return in today's environment for investments. So far you have 2 pieces of information that we're calculating. A return on investment using the DuPont model and a return on equity using net income over average owner's equity. To those two things, we're going to add three other pieces of information, which are going to relate to liquidity. Liquidity means this is a measure of the ability of a firm to pay its bills. The slide says it's the ability to meet current obligation. Those are your current bills. Most of the time, working capital and liquidity are simply a relationship of the current assets to the current liabilities of the firm. Now let's review what those terms mean. Current assets, remember, are the assets which a firm has, things that are of value to the firm, that are going to be used within the next 12 months. So they're going to be quick assets or current assets, things that we're going to use fairly quickly. Those would include accounts receivable, cash, short-term securities, inventory. Those sorts of items will all be current assets. On the other hand, current liabilities are those bills or obligations that you will have to pay within the next 12 months. So that would be things like wages payable, taxes payable, accounts payable. Those items will all be current liabilities. Now the nice thing about most financial statements that you'll read on the web or that you get in hard copy will actually have the current assets and current liabilities lined out for you. They'll have specific totals for those, so that you will not have to actually calculate those yourself, although you will be able to do so if you remember what current assets and current liabilities are. So the first of the three things we're going to look at will be working capital. Now working capital simply tells you how much money, and this is going to be a dollar amount, a firm will have left over after it pays all its bills. So you're assuming here that a firm is going to turn all of its current assets, all of the inventory, cash, accounts receivable, into cash, and they're going to use that cash to pay all their bills. How much cash would they have left over? And that would be their working capital. So to compute it, it's the first line on the slide that you see there. It's simply current assets, that's a dollar amount, minus current liabilities, which is another dollar amount. So your ending result there would be a dollar amount. Now this is not going to be a very useful number if you're calculating working capital for firms of two different sizes, because a large firm will have a larger dollar amount of working capital than a smaller firm. So it's a nice number to know, but it doesn't give you the ability to compare firms of different sizes. So what we often do is take that working capital computation and translate it into a current ratio computation. Now again, remember we said ratios were easier to use when you were comparing firms of various sizes. You could compare a large firm, a middle firm, and a small size firm, all using the same ratios. So the current ratio is simply the relationship of current assets to current liabilities. To compute it, you use the first line of the slide up there, current assets divided by current liabilities. Remember, current assets are a dollar amount, current liabilities are a dollar amount. So when you divide dollars into dollars, you'll get a number, which will be something like 2. Should be close to 2 in most companies' books. That's a ratio of 2 to 1. You should have about twice as many current assets as you have current liabilities. Generally, you want that number to be higher. The higher the better, up to a certain point. If you get a current ratio that's too high, perhaps you have too much of your capital invested in current assets, and you should actually be using that money for long-term assets to get a higher return. So if you get up around 5 or so, you would want to be wary of a firm that has a current ratio too high. So you have a working capital computation that results in dollar amounts. You use the same numbers to compute a current ratio, which gives you a ratio number, which you can use across firms. That's a nice number to know in order to look at a firm's liquidity over a year. But often what we want to do is compute a little bit better ratio relating a firm's debts to its ability to pay those debts, and we call that the acid test ratio. In the acid test ratio, all we use to compute the top number are the amounts in the accounts that can actually be turned into cash very quickly. So another name for this acid test ratio is called the quick ratio. Quick meaning how quickly you can turn these assets into cash. The quick assets consist of cash, temporary investments, and your accounts receivable. Now notice we left inventory out of there because inventory is fairly difficult to change into cash in a short term. Accounts receivable can easily be changed into cash by taking them to a bank and having them do what we call factoring your accounts receivable, in which they actually buy the accounts receivable from you. Obviously for less than what the dollar amount shows it being worth, but you still can get cash pretty quickly. So to compute the acid test ratio, you take your quick assets, cash, temporary investments, and accounts receivable, and divide them by your current liabilities. You would like to get a number around 1. In other words, you'd like to have about the same amount of quick assets as you have current liabilities. That means that you then have the ability to pay all your bills very quickly without going into debt. So you're looking for a ratio of 1. Again, ideally you'd like for that number to be higher, and higher is better. But again, you don't want it too high. Too high means that a company is not investing wisely in their assets, especially their long-term assets. The last piece of this chapter deals with trend analysis, because when you're doing financial analysis, typically you're not looking at just 1 year or 2 years as we're doing in the book, just to kind of get you used to doing this sort of analysis. Typically an investment requires that an analyst look at a 5-year range or longer, because what you're looking for are trends. How well is management doing in their liquidity? How well is management doing in their debt control? How well is management getting a return on their assets? One point in time gives you a good picture of what's going on now, or at one point in time in the past. A trend analysis shows you what management's theory is, how well they're controlling all the pieces of the pie. So you want to look for trends. You want to do this over a period of time and look for some sort of increase or decrease or stabilization of those assets. Remember, ratios by themselves are just ratios. They don't mean a whole lot. You need to have something to compare them to, and you need to look for trends. So you say, okay, I'm going to do trends. What am I going to compare them to? Well, there are a number of ways you can do comparisons in analysis. You can compare firms to one another. In other words, you could do Coke and Pepsi and relate the two to see how each company's doing related to the other one. Or an even better way is to look at what we call industry data. In the library you can find books that have standard industry ratios, the average ratio for the firm of fast food, let's say. So you could figure out, looking through the book, what the average ratios are for all the fast food industry. You could do an analysis for, say, Wendy's and McDonald's and Hardee's, and compare those to the industry averages. So that's one of the neat ways that you can do financial analysis, to look at what everybody else is doing and compare your firm to the average. Even better, what I like to do is to take several companies within an industry, compare them to one another and to the industry average. Then you get a pretty good picture of where the firm stands in their ability to control their asset use and their debt payments. So what we're looking for again then is, how well is management running the firm? And we can do that by looking at the financial statements and analyzing them slightly. So let's practice doing that. Let's do that by looking at exercise 1 in your textbook in chapter 3. And exercise 1 is on page 83 at the very top of the page. What you have here are two friends who are each going to have some sort of little financial investment. They want you to put some money in. Julie is wanting you to give her $560, and Sam needs $620. And what you're going to get back on your investment from Julie is $50, and from Sam is $53. So the question there is, okay, which one is the better investment? In other words, which has the better return? To figure that, you take the amount of the return and divide it by the amount of the investment. So for example, there with Julie, you're going to get $50 back on $560 worth of investment, so you'll get a return of about 8.3%. Sam, on the other hand, is going to give you $53 back, which sounds like more return, but you're having to invest $60 more, or $620, so your return from Sam is only 8.55% return. So if you're looking at just the amount of return, you would want to give your investment to Julie, assuming you can only pick one of the two. However, the one thing you might also want to consider when you're looking at these two investments, which one is riskier? Is Julie's investment much riskier than Sam's? If so, you may want to adjust the fact that the 8.93 looks like a better return by saying, oh, there's a lot less chance that I'll get my money back with Julie than with Sam. So always consider risk when you're looking at an investment. Okay, let's practice a little bit on our DuPont model for ROI. And let's use two problems in the textbook that have 6 different examples included in the 2 problems and practice doing some ROI calculations. So let's start with exercise 5, which is the very top of your book on page 84. And let's work through how we're going to work these problems. Start out by writing for yourself up at the top of your page what ROI is. ROI is equal to margin times asset turnover. Then underneath that, write to yourself, the ROI is equal to, remember the margin is net income over sales, times your turnover, which is sales over average total assets. With those 2 formulas at the top of your page, you can work any of these 6 problems. So for example, let's look at problem A. Firm A has a margin of 12%, sales of $600,000, and ROI of 18%. Calculate their average total assets. Anytime you have an ROI and either margin or turnover, you can compute the other one. So in this case, we have the ROI of 18, we have the margin of 12, so we can compute our turnover. Simply set up your formula, 18 equals 12 times some unknown amount. Take your 18%, divide it into 12, and you'll get 1.5. Now that you know both your margin and your turnover, you can compute the other one, the other amount they wanted you to figure, which was average total assets. Well, average total assets is included in the turnover part of your ROI formula. So now that you know that your turnover is 1.5, you know that your sales are $600,000, you want to compute your ATA or your asset turnover. So you simply take 1.5, set it equal to the 600,000 divided by ATA. As you compute, solve for that unknown in your formula, you'll find out that your average total assets equal $400,000. Let's do another one just for fun. Part B. Now look what they give you in Part B of this problem. They have net income of $78,000. They have a turnover of 1.3 and average total assets of $950,000. They want you to compute sales, margin, and ROI. In this case, we only have one of the 3 pieces in that top formula. We only have given to us turnover. So let's compute what we know about turnover. We know turnover is 1.3, and we know you calculate turnover by taking sales over average total assets. So let's set 1.3 equal to sales divided by the $950,000 they gave us for average total assets. And we can compute that sales is equal to $1,235,000. Well, if we know sales and we know average total assets, if we know now our sales number, we know our turnover number, we know our average total assets, can we compute margin or ROI? Which one would you do next? Well, let's see what our ROI would consist of then. Our ROI would be $78,000 in net income, which they give us, divided by the $1,235,000. So that's our margin number. We can compute that, and we get 6.32%. So our ROI then would be 1.3 times 6.32%. So our total ROI would be 8.21%. That one was a little bit harder than the first one. So let's see what the third one looks like. Now remember, we're going to set up our formulas. kind of ingrain these two formulas into your head. ROI equals margin times turnover. ROI equals net income divided by sales times sales divided by average total assets. Then look at the problem. Firm C has net income of $132,000. So you know one piece of information. Turnover of 2.1 and ROI of 7.37. Remember what I said a minute ago. If you know ROI and either margin or turnover, you can compute the other one. In this case, we know turnover and we know ROI, so we can find our margin. Simply take our ROI of 7.37, set it equal to our margin times 2.1, which is our turnover that's given, and we can figure that our margin is equal to 3.5%. If we know that, we've computed all the pieces that we need to compute. Problem 6 is exactly like problem 5, except it's got 3 more scenarios for you on how to compute ROI using various pieces of information. We'll do one and then I'll leave the last 2 for you, although the solutions are here on the slides. You'll be able to compute them yourselves. Let's talk ourselves through this first one in problem 6 and see how we do it. The first thing you're going to do is write down your 2 formulas. ROI equals margin times turnover. Then ROI equals net income divided by sales times sales divided by average total assets. Let's plug in the pieces that we know. It says Firm D has net income of $27,900. So we know net income. It has sales of $930,000. Well, if we know net income and sales, we now know our margin. We simply take $27,900 and divide it by $930,000. That's going to give us 3%. We also know in this problem that we have average total assets of $465,000. Well, if our sales are $930,000 and our average total assets are $465,000, we can compute our turnover. Our turnover would be 2%. So ROI would simply be then our margin times our turnover, which would be 3% times 2, or an ROI of 6%. So a good practice for you now is to go through and look at those last 2 problems in problem 6. Practice using the 2 formulas, writing them down for yourself, plugging in the pieces of information that are given to you, and see if you can calculate the missing amounts. If you have trouble with them, the solutions are here on the slides that are available to you on Blackboard, so you'll be able to check your answers as you go through. But practice those. Those are very important calculations that you need to be very familiar with. Let's do one that's not quite so cut and dried. Let's do one that has a little bit more reading in it, a little more interpretation for you. Let's look at exercise 8, which is down that same page 84, about halfway down the page. It says for the year ended December 31, 2004, a company's earned an ROI of 12, sales were 12 million, average asset turnover was 2.4, and average owner's equity was 3 million. The first thing they want you to do is to calculate margin and net income. Sounds like an ROI formula to me. So again, the first thing you're going to do is write down your 2 equations. ROI equals margin times turnover. ROI equals net income divided by sales times sales divided by average total assets. Plug in what you know. You know that your ROI is 12%. You don't know net income. They don't give you that figure, but they do give you sales as 12 million. They don't give you the numbers for average total assets, but they tell you that your turnover is 2.4%. So using your formula, you can set 12% equal to net income divided by 12 million times 2.4, and you can figure out what your net income is going to be, crunching through there. Your net income is going to be $600,000. The second part of the question asks you, what is their return on equity? Now that's a new twist because we hadn't worked a problem with return on equity. Remember, return on equity, the return is gauged as net income, which they give you as $600,000. They give you the average total assets as being $3 million. So to find your return on equity, simply divide the $600,000 by $3 million, and you'll get 20%. So that's a good practice on your ROE calculations. Let's do another one as practice. Let's look at problem 12. Now that's in your book on the next page, over on page 85. In the middle of the page, they give you information that's much more realistic than just giving you written problems here. Look at what they've given you at the bottom of page 85. They give you a balance sheet. Looks familiar, doesn't it? They give you 2 years worth of information in that balance sheet. 2004 is in the first column. 2003 is in the second column. And if you turn the page, at the top of page 86, they give you the rest of the balance sheet, which is the owner's equity section. Now, one of the things to remember when you look at this problem is they don't give you an income statement. Now, think about your ROI formula. You need to know net income. Instead, they bury net income in the owner's equity section. So as you're reading through the owner's equity section at the top of page 86, notice that under retained earnings, it gives you the beginning balance, and then it gives you net income. So that's where you're going to find your net income number. So let's look at problem 12 here. Let's work through the first 5 pieces. We don't need to do F and G, but let's look through the first 5. In A, they ask you to calculate ROI. So you know the first thing you're going to do is set up your 2 formulas. ROI equals margin times turnover. ROI equals net income over sales times sales over average total assets. Now let's look at the balance sheet and figure out where these numbers are on the balance sheet. Remember, I just told you net income is buried in the owner's equity section, and they give it to you as $34,000. Sales, they tell you what sales is. It's the last line above the block there on page 85 where they give you the balance sheet. It tells you that sales are $580,000. Then you take that sales of $580,000 and you divide it by average total assets. Well, in this case, you have to compute average total assets. So what you need to do is read down your balance sheet there on page 85 and find the total asset numbers for 2004 and 2003. 2004 total assets were $312,000, and for 2003 they were $280,000. So you're going to add those 2 numbers together and divide by 2. That will give you your average total assets. So when you take your net income and divide it by sales, you get 5.86%. When you take your sales and divide it by your average total assets, you get 1.959. So your total ROI in this case is 11.5%. In part B, they want you to calculate ROE. Now remember from the previous problem, ROE is calculated as net income over average owner's equity. Net income is given to you in the owner's equity section of the balance sheet as $34,000. Average owner's equity has to be calculated though. So if you look over the balance sheet on the top of page 86, it tells you your total owner's equity for 2004 was $196,000, and your total owner's equity for 2003 was $167,000. If you add those 2 numbers together and divide by 2, that will give you your average owner's equity. You take that resulting number, divide it into $34,000, and you get 18.7%. In part C, what they want you to do is to calculate working capital. Now remember, working capital is simply the relationship of 2 numbers, current assets minus current liabilities. It's going to give you a dollar amount. So the first thing you have to do is go through and find current assets. Well, fortunately, if you look down the balance sheet there, they give you the current asset numbers. You don't have to calculate them. Current assets for 2004 are $202,000. If you continue looking down the 2004 column under liabilities, they give you a total for current liabilities of $94,000. So your working capital is equal to $202,000 minus $94,000, which gives you $108,000. That tells you the firm has $108,000 that they're able to work with to buy equipment, to pay for more inventory. That's their capital to work with. Now also remember that I told you that a ratio is probably much more useful if you're comparing firms of different sizes. So the next thing they want you to calculate here in Part D of this problem is the current ratio. You're going to use the same two numbers you used in Part C. The only difference is you're going to use them as a ratio instead of as a difference. So this time you take your current assets of $202,000, divide them by your current liabilities of $94,000, and you get a current ratio of 2.15. Now you may remember that we talked about the fact that a 2 is a current ratio is a pretty good ratio. So they're doing fairly well in their current ratio. The last thing they ask you for is the acid test ratio. Remember, this is a gauge of how well they're controlling their current debt to their current assets. The current assets meaning those assets that can quickly change into cash. If you look at this company's current assets, they only have 3: cash, accounts receivable, and inventory. Inventory is never included in the acid test ratio, so you only have 2, cash and accounts receivable. So you add $21,000 and $78,000, divide it by $94,000. You end up with an acid test ratio of 1.05. Now that's a pretty good quick ratio. You want it to be around 1 or higher, so they're doing okay. The only thing that they could have included in those current assets that would be in addition to those, what we used, just cash and accounts receivable, if they had had short-term investments in there, you would need to add that in too. But this company didn't have any short-term investments, so you didn't have to worry about it in this problem. Let's do one more problem. Let's look at problem 13 in your book, which is at the middle of page 86. And again, we're analyzing liquidity measures, so we're going to do a lot of the things we just did a few seconds ago, but it's just practice for you. What you have here is, again, is a balance sheet with 2 columns, one for 2004, one for 2003. And the instructions for the problem tell you to calculate certain pieces of information. In Part A, they ask you to calculate the current ratio and working capital for each of the 2 years. So remember, working capital is simply current assets minus current liabilities, and you're going to get a dollar amount. For 2003, your current assets are $18. Your current liabilities are $6, so you get a working capital of $12. In 2004, your current assets are $14,000. Your current liabilities are $9, so that leaves you with $5,000 of working capital. To compute the current ratio, you simply take those same numbers and divide them. For 2003, you take 18 divided by 6, you get 3. That's a pretty strong current ratio. Then in 2004, you take your 14 and divide it by 9. You get a much smaller current ratio in 2004 at 1.56. So the next thing they say, okay, now knowing that information, how would you assess the company's liquidity? Well, if you look just at the cash balance, they have $5 in cash in 2004, whereas they only had $2 in cash in 2003. So it's kind of misleading in that they seem to have more cash, but they're less liquid. They're less able to pay their bills in 2004 than they are in 2003 because their other accounts have gone up. Their other current liabilities have increased. Finally, in Part C, they ask you to assume that the firm has operated a loss during the year. How could cash have increased when you have a loss? Well, you can collect your accounts receivable. Remember, accounts receivable are from sales of previous periods. Or perhaps they sold some inventory and they didn't bother to replace it. They simply sold it out. So they could have increased their cash by simply selling and not replacing, or collecting and not allowing people to charge. So it is possible to increase your cash balance and still not make as much money in the short term. So what we've talked about today in Chapter 3 are 5 things. Return on investment using the DuPont model. Return on equity, which is simply net income divided by average owner's equity accounts. Working capital, which is simply a dollar amount difference between current assets and current liabilities. A current ratio is simply the relationship of current assets to current liabilities. And finally, the acid test or quick ratio, which is the relationship of your quick assets, those that can be turned into cash very quickly, to your current liabilities. So that's a summary of what we've done in Chapter 3. We'll continue talking about these later on. Don't lose your DuPont model because we'll be using it in the following modules. Thank you.